All right, let's get right into it. Today, we are unpacking a truly fascinating case study in corporate reinvention. I want you to imagine a 160-year-old financial giant, commanding a market cap approaching $100 billion. We're talking about U.S. Bancorp, the parent company of U.S. Bank. You know, you'd normally expect a legacy institution of this massive size to move, well, kind of like a glacier. But right now, U.S. Bancorp is undergoing this aggressive, almost startup-level transformation that pretty much nobody saw coming.
And look, the market is absolutely paying attention. Over the past year, we're talking about a staggering 34% return on the stock. To put that into perspective, that totally eclipses the S&P 500's 18.7% gain over that exact same time frame. It recently pushed the stock to a new 52-week high of $66.08. So you have to ask yourself, what exactly is fueling this massive surge?
Well, here is our roadmap for today's explainer. First, a leadership-driven transformation. Second, record-breaking Q2 earnings. Third, the bold BTIG acquisition. Fourth, Wall Street's verdict. And finally, the real-world risks and shareholder rewards.
Okay, Section 1, a leadership-driven transformation, the catalyst for change. It really all starts in April 2025, when Gunjan Kedia stepped in as CEO. And this wasn't just some routine changing of the guard, right? This was a major strategic pivot. Just look at the timeline here. In her very first year, she oversaw a 46% gain in the stock, and by July 2026, she led the bank straight into record second quarter revenue. That is a massive amount of shareholder value generated in a remarkably short window.
So how exactly is she pulling this off? Well, she's executing on a very specific, aggressive checklist. Her priorities are incredibly clear-cut. Number 1, accelerating revenue growth. 2, maintaining disciplined expense management, which she actually calls a hallmark of the company. 3, expanding fee-based revenue streams. And 4, heavily building out their capital markets capabilities. Keep that last point in mind because it is a huge piece of the puzzle we're looking at today.
Moving on to Section 2, record-breaking Q2 earnings, validating the strategy.
Check out these hero stats from July 2026. I mean, they are wild. Net revenue hit a record $7.71 billion. That's up over 10% year over year. Diluted earnings per share came in at $1.35. That is a 22% jump. And it actually beat the Zacks consensus estimate by 5.5%. Net income reached $2.18 billion, and their return on tangible common equity, a crucial measure of bank profitability, expanded by 70 basis points to 18.7%. The execution here is perfectly matching the leadership's ambition.
But honestly, it's not just about how much money they made, it's about how they made it. Fee revenue jumped 13.2% for the quarter. That means fees now make up 44% of total revenue. Why is that a big deal? Well, banks with higher fee income usually have much more stable earnings through, any kind of economic cycle. They're not just crossing their fingers and relying on traditional net interest income spreads. This is a very intentional structural shift.
And even with this aggressive growth, the underlying fundamentals are rock solid. Kedia pointed this out on the earnings call, highlighting strong loan growth and a third consecutive quarter of record consumer deposits. But the absolute most crucial part of her statement, credit quality continues to improve. Actually, think about this. They grew commercial loans by 14.1%, but their net charge-off ratio declined from a year ago. Plus, non-performing assets dropped by almost 20%. So they're growing fast, but for sure, they're doing it safely.
All right, Section 3, the bold BTIG acquisition, shifting the paradigm.
So, back on June 1st, 2026, U.S. Bancorp closed a $1 billion acquisition of BTIG. If you look at historic, traditional U.S. Bancorp, they were known for commercial lending, gathering deposits, serving their 15 million clients. Incredibly strong, but kind of weak in the investment banking space. Enter the new BTIG capabilities: institutional equity trading, M&A advisory, prime brokerage. Basically, overnight, this traditional commercial bank unlocked an investment banking powerhouse that has a resume of over 1,350 transactions since 2015.
And the immediate results? Pretty fascinating. In June 2026, literally its very first month under U.S. Bancorp, BTIG generated about $98 million in revenue. That is the strongest monthly revenue performance in BTIG's entire history. Now, to be fair, it did come with about $84 million in expenses for the quarter, so there's a real near-term expense drag here, but it's the long-term strategic value that analysts are completely locked in on. Stephen Phillipson, the vice chair, summed it up perfectly. He stated that BTIG adds highly complementary capabilities, making them better positioned to meet a broader range of client needs. The overarching goal here is huge. Management wants to grow capital markets to more than 10% of total company revenue over time.
Next up, Section 4. Wall Street's Verdict. Analyzing Market Sentiment.
Out of 23 analysts polled recently, there is an overwhelming consensus. The stock holds a moderate buy rating. You've got Barclays, Jefferies, Citi, and Oppenheimer all issuing buy ratings, with targets well into the 70s. The average price target sits at $70.32, so that implies a really solid 12% upside from current levels, especially with earnings per share expected to grow nearly 13% for fiscal year 2026. Wall Street is clearly fully on board with this new direction.
But, these optimistic price targets aren't just based on what the bank is doing internally. They're heavily supported by broader industry tailwinds. Right now, stable interest rates are propping up net interest margin expansion. We are seeing rising wholesale and consumer loan demand thanks to a pretty decent U.S. economic outlook. Plus, banks like U.S. Bancorp are heavily investing in restructuring, digitization, and AI. The macroeconomic wind is very much at their backs.
Finally, Section 5, Risks and Shareholder Rewards, the reality check.
All right, time to ask the hard question. What could actually go wrong? Because before we draw any final conclusions, we have to ground ourselves. We need to look at the real macroeconomic and operational hurdles standing in the way of this massive transformation.
Let's just impartially break down the threats. First up, recession risk. An economic downturn obviously means lower balance sheet growth and higher credit costs. Second, those BTIG integration costs. Non-interest expense went up by $125 million, or 8.5% in Q2 overall. Third, regulatory scrutiny. U.S. Bancorp disclosed that multiple federal authorities are looking into the bank regarding the administration's push to crack down on de-banking practices. We aren't taking any political sides here, but it is an objective regulatory reality that investors absolutely need to keep an eye on. And finally, some folks are just laser-focused on the exact timing of when this margin expansion will fully materialize.
Despite those risks, though, there's a pretty massive counterweight for shareholders, and it's summed up in one number: 56. U.S. Bancorp has a staggering 56 years of uninterrupted dividend payments. They also just hiked their quarterly dividend by 3.8% to 54 cents a share. That marks 15 consecutive years of dividend increases. If you want a masterclass in historic resilience, that's it.
So, the crucial question we're left with is this: does the reward outweigh the risk? We've got a 160-year-old bank undergoing this bold, aggressive transformation. They're delivering record revenues, unlocking investment banking through BTIG, and clearly capturing Wall Street's attention. But they still have to outrun integration costs, regulatory scrutiny, and those lingering macroeconomic headwinds. So, will this 160-year-old giant successfully reinvent itself, or will the sheer weight of its own ambition slow it down? That is the defining question you should be watching. Thanks for joining me on this explainer, and keep learning.